You put your money in a bank. You feel safer instantly. The screen shows a balance, a little number telling you everything is fine. Here's the uncomfortable part. The moment you save that money, it stops being yours. Not metaphorically, legally, mechanically, by design. And almost nobody explains this clearly. So let's slow it down. Imagine this. You work, you get paid, you deposit $1,000 into your bank account. You think the bank is holding your money, like a locker or a vault. That picture is wrong. What actually happened is much stranger. The bank didn't store your money, you gave it away. In exchange, the bank gave you a promise that says, if you ask for it back, we'll give you an equivalent amount. That's it. Your savings account is not a storage box, it's a loan you made to the bank. And this isn't a loophole, it's not shady, it's how the modern money system works everywhere. This matters right now because people are saving more, worrying more, and trusting less. Interest rates are high, banks are in the news again, and suddenly everyone is asking the same question. Is my money actually safe? To answer that, we have to understand what saving really means. Let's rewind. Banks started as actual vaults, gold in, paper receipt out. If you had the receipt, you owned the gold. But banks noticed something. Most people didn't come back at the same time. Some money just sat there. So banks did something clever. They lent some of it out. Not all, just enough to earn interest. And if withdrawals came in, they could cover them. This was the birth of fractional reserve banking, a system built on probabilities, not certainty. Today, it's even more abstract. When you deposit money, the bank doesn't put it aside, it records a liability. Your balance is what the bank owes you. At the same time, it uses your money immediately to make loans, to buy assets, to invest, to earn. Your savings become fuel. Let's make this concrete. You deposit $1,000. The bank keeps a small fraction as reserves. The rest is lent to someone else. That borrower spends it. That money gets deposited again. And now the system shows more money than you originally put in. Your $1,000 quietly became several $1,000s of claims. Everyone sees a balance, everyone feels solvent, but there is only a fraction of real liquidity. This works perfectly as long as not everyone asks for their money at once. That's the deal. Banks don't fail because they're evil, they fail because they're fragile by design. Now here's the part that sounds wrong but isn't. You don't legally own the money in your bank account. You are an unsecured creditor. If the bank collapses, you stand in line. Yes, there's insurance. In many countries, governments insure deposits up to a limit. But notice what that really means. Your money is safe not because the bank is safe, but because the government promises to replace it if things go wrong. And that promise is backed by more debt, more money creation. Which brings us to the quiet irony. Saving money feels conservative, responsible, stable, but the act of saving inside a bank actively feeds a leveraged system. Your caution becomes someone else's risk. Let's talk interest. Banks pay you a small percentage for your savings. It feels like a reward. But zoom out. Your money is being used to generate much higher returns elsewhere. Mortgages, corporate loans, financial markets. You get the lowest slice, the bank keeps the spread. And inflation quietly works against you. If inflation runs higher than your savings rate, your money loses purchasing power even as the number goes up. Your balance grows, your buying power shrinks. That's not a bug, it's a feature. The system needs money to move. Idle money is punished softly, not loudly. Now let's address the hype. People say banks are safe, regulated, stress-tested. That's mostly true. But safety here doesn't mean what people think. It doesn't mean your exact dollars are waiting for you. It means the system assumes most people won't panic at the same time. Confidence is the real reserve. And history shows what happens when confidence breaks. Bank runs don't start with math, they start with stories, a rumor, a headline, a line outside a branch. The moment people collectively remember that their money is not physically there, everything changes. This is why governments intervene so aggressively, why central banks step in fast, why they say everything is fine before anyone asks. Because once trust cracks, speed matters more than accuracy. Zoom out even further. This structure concentrates power. Banks decide who gets credit, who gets liquidity, who grows, who stalls. Your savings don't just sit quietly. They help shape the economy. They fund housing booms, corporate expansions, speculation, and when things go wrong, losses are socialized, but gains remain private. That's not conspiracy, that's structure. So why do we accept this? Because the alternative is worse. If banks held every dollar untouched, lending would collapse, growth would slow, credit would dry up. Modern economies are built on borrowed time and borrowed money. Saving feels personal, but it's deeply systemic. Here's the uncomfortable math. Your money isn't there, it's everywhere and nowhere. It exists as promises layered on promises held together by trust, regulation, and emergency backstops. Most days that's enough, until it isn't. So when you check your balance tonight, ask yourself a different question. Not how much do I have, but how much of this system do I trust? Because your savings account isn't just about you. It's a quiet vote of confidence in a machine that only works as long as everyone believes at the same time. And the real question is, what happens the day they don't?